Happy Monday, everybody. I hope you had a great weekend. Today is June 5th, 2023, and this is your Monday Market Update. Another big week crammed into the 4 days last week, so let's jump right in, review last week day by day, and preview this coming week ahead. Monday was Memorial Day, of course, and the markets were closed. Tuesday saw the market's first chance to react to the debt ceiling deal that was struck between the President and House Speaker Kevin McCarthy, announced over the weekend, to much fanfare, of course. This had stocks reacting, as we had been saying. Stocks moved up on Tuesday on that news, and the news from NVIDIA, and the continued move into and out of the trillion-dollar status. This is the first chip company to see that level, and that gives optimism to the whole tech sector. Eco news as of Tuesday was a bit hotter than expected, and this boosted the odds of a June Fed rate hike. For now, this worry that the Fed pause may not come about weighed on stocks, and the S&P drifted lower throughout the morning. There was some chatter that the Republicans were not going to support the deal. No one really believed them, but add that to the new X date of June 5 from Yellen, and the market headed to session lows. The markets did stabilize. The markets ended pretty close to where they began. S&P actually flat for the day. The Dow was down less than 1/4%. The Nasdaq up 1/3%. The market gapped lower on Wednesday on the normal Washington drag of the process to pass the debt ceiling agreement. Add to that the eco data from China that put into question more about the global recovery. April JOLTS numbers were out, and the market took another leg lower as there was another unexpected rise in jobs outstanding, and an upward revision to March jobs. So solid labor markets, not what the Fed wants to hear. Early markets were showing a 75% chance of a June rate hike. That was short-lived, though, as the afternoon brought about some Fed heads talking about the new term skip in regard to the June meeting. Different than a pause, just a skip. Rate hike odds flipped again, and the stocks went higher, but late selling brought the markets off the best levels of the day. The Dow, S&P, and Nasdaq all down about 0.5%. Markets opened pretty much unchanged on Thursday as the expected vote passed the House and headed to the Senate, then on to the White House, where support has already been pledged. ISM report was out along with the ADP report showing wage growth slowing. This showed the unit labor costs lower than expected, and oh boy, dovish? No. Odds of a rate hike are now down to 25%, and that is enough to get the market moving. Breadth of the rally widened out, and with the data showing inflation falling off, markets were strong. Soft landing are the words of the day. Markets ended higher. S&P and Nasdaq at the highest since August. The Dow was up 0.5%, the S&P up 1%, and the Nasdaq was up 1.25%. Quick talk about leadership as June gets started. Mega cap tech, as you know them, Apple, Google, Microsoft, Amazon, and NVIDIA represent over 75% of the S&P total return year to date. Fun fact, valuations. Market PE is over 18 overall, but if you take out the 6th largest mega cap tech, the PE drops to 14. Is that more reasonable? You just have to see. Ending the week, all three indices opened higher on Friday, with the Dow pushing into positive territory on the week. More on that in a moment. The Nasdaq did trade at the highest level since April 2022. Non-farm payrolls out, and U.S. jobs for May, much better than expected. Good news today is good news. Go figure. We've been reading that the other way for weeks, if not longer. So this will make an interesting time for the Fed. Growth surging, debt ceiling done, skip, pause, CPI, PPI still coming, soft landing talk, inflation waning or not. Overall, glass was for sure half full on Friday. The Dow was up 2.12% on the day. S&P up almost 1.5%. The Nasdaq up a bit over 1%. Just to wrap up for the month of May, of course, that was on Wednesday. S&P up 0.25%. The Dow was down about 3.5%, and the Nasdaq was up almost 6% for that month. For the full week, as June gets started, the Dow was up 2%, the S&P up a bit over 1.75%, and the Nasdaq was up over 2%. 6 straight weeks higher, not seen on the Nasdaq since 2020. A few quick notes on what the debt ceiling deal means to the market. First, the deal isn't really a long-term positive or a negative for the markets. If spending would have been changed a lot like it was in 2011, we would have had to talk about things like that, like economic growth. But this deal did not change that much, so not such a big deal for that. There was a surprise positive in energy on the bill. A pipeline in West Virginia was approved, not much else. Big deal was the student loans. As I mentioned on Friday's planning video, loans will return to normal as of September 1 after a 3-year pause. Payments are due again, and over 40 million Americans hold student loans. Go back and listen to Friday's video for more information on that. Finally, one of the items that may provide some headwinds to risk assets once this deal is signed, expect the Treasury to refill their coffers and issue over $1 trillion in new short-term debt. This will weigh on things, but overall, more of a non-event than anything else. On to bigger and better things. Well, bigger. Let's see if they're better. Let's focus. Stretched valuations, recession concerns, path of interest rates, strength of the consumer, and profit margins. Let's see what the next shiny object is in this market. Another item to keep an eye on as we enter June. Sell in May and go away. Maybe. Well, as we saw, May was not so bad, but June is no prize in seasonal markets. Overall, June is the fourth worst performing month since 1950. Positive only 54% of the time. Tech in June looks even worse since, of course, it was so strong in May. Since 1990, the tech sector has averaged monthly returns of 0% in the month of June. Median return of negative 1.75%. That's the second worst month on average and the worst on median. Only positive 42% of the time. Lowest rate on the calendar. Finally, before we preview the week, recall that Powell's messages have been coming about the upcoming pause, but in reality, it's up to him to a certain degree. But it's really up to the data, no? So we talked about the NFP report from Friday. We still have CPI and PPI before the Fed releases their next decision. Coming this week, as usual, for the week after the NFP, much less happening. Will the markets comply? We will see Apple's Worldwide Developers Conference, some consumer credit numbers, a few earnings reports, and only one scheduled Fed head for now. Since the Fed heads are in blackout period, you'll not hear anything from her about monetary policy, so not much to see here. There will be a lot of talk about all the rest of the news, back to AI and about tech. The tech kings with no debt ceiling news, no big earnings reports, not too much on the domestic eco data, and the Fed in the blackout period, almost as if it'll be a sleeper. I'd imagine that something else will give. Let's see. For now, remember to stick to your plan. We'll stay focused on your goals and how to get there. This is an ever-changing landscape. Stay nimble and stay in touch. Friday, we'll come back with some more planning ideas. Have a great week.